So yeah, so to start off, I wanted to touch on enterprise value and comparables because this is actually probably the most critical concept that you want to learn if you want to prepare yourself, not just for investment banking, but any sort of investment related, capital markets related role. So let's jump into it. What am I talking about here? Well, um, and actually, before I jump in, maybe just my quick spiel about me and my company, just so kind of you know a bit about my background here. So my name is Josh Jia, and I've been doing professional coaching for about 10 years and for about 4 years, more or less full time. So I started this business finance interview coach 4 years ago, but the inspiration of it actually came about roughly a decade ago when I was in your shoes as a second year university student. I could not get into a single investment club, no matter how hard I tried. So what did I do? I started my own. A club called Limestone Capital, and it's really grown today. So through that club, I started the school's first interview prep class, and after that, I worked a couple years in investment banking at the Bank of Montreal in 2014, and then I did a couple years of private equity at a mid-market shop that manages about 650 million assets under management, called Imperial Capital. So yeah, it's a bit about me. Now, what inspired me to do this? Well, I don't think anybody really teaches this stuff well. And that's because like professors aren't going to teach this because they tend to teach stuff that's, 20 years old or, this is still pretty new. Professionals won't teach this because they're usually too busy. So I found a real opportunity. I really am passionate about this content. So that's what I do. I offer one-on-one kind of interview prep for either investment banking, private equity, corporate development, financial modeling, case studies, whatever it is. And I charge 150 US an hour. And I do my sessions through Google Meet, much like we are right now. So my goal here today is to try to give you guys something that's useful. So let's jump to it. What is enterprise value? Enterprise value, it's the value of a company, right? And you've maybe heard this term before. Really, if we were to simplify it, this is what the formula looks like. Market cap plus debt minus cash. What's going on here? Well, we're saying the value of a company is, what it's financed by, right? So where is the money coming from? Well, it can either come from equity, so the stock market. So market cap is just the share price times shares outstanding, or debt. Debt kind of, being another way to finance those assets. And then we subtract cash. And the reason we subtract cash is because when you think about it, if you're buying a company with cash, right, it's like buying a piggy bank. If you're buying a piggy bank that has $5 of cash in it and it's worth 15 bucks, you could say to the seller, why don't I just pay you $15 and you keep the $5? I don't need to buy your cash with cash. So that's why we take out cash. Another way to think about it is you can use the cash to pay off debt. So that's why we're subtracting cash here. Actually, Chris, I want to take a step back here. Is everybody here sort of like, is this sort of like the right pace? Like, do people already know this stuff, or is this sort of a good, do you think this is like a kind of a good thing to review for everybody? If you don't mind me asking here.
I think we have a pretty diverse group, so maybe if you could just
Okay.
do a little bit of a quick review,
Okay. Yeah.
so that everyone can follow. Yeah.
Got it. Okay. So luckily you guys should have all the slides, so hopefully it's relatively straightforward. Okay, now let's go into the full enterprise value formula. A very common question. What is the enterprise value formula? Okay, so I added preferred equity. What is preferred equity? Let's jump into it. Preferred equity, it's like debt. It's basically debt, except the company doesn't want to call it debt, so they call it preferred equity because they don't want it to like mess up their debt over equity ratio or something like that. Now, why is it like debt? It has claim over dividends before the common shares do. So it's like, well, if you're going to get the quote unquote dividend before the shareholders do, that's basically like a bond coupon, right? Like you're getting a fixed payment no matter what, pretty much. So yeah, it's basically like that. So that's why we're adding it just straight up like that, because it's sort of like borrowing money. Okay, what's minority interest? This is a hard one to explain, so I'm going to try my best here. Minority interest, first, let's start with the topic of consolidation. Why do we add minority interest? Well, first, consolidation. If you own 75% of a subsidiary, you have to consolidate. So that's 100% of the income statement. So we're talking like all the revenues, all the costs, 100% of the EBITDA of the subsidiary is going into this. So this is just an accounting rule they made up for whatever reason. You'll find that finance is often reversing the actions of accountants. I mean, as much as I love accounting. Now, what does this mean? This means that if we're looking at an enterprise value over EBITDA multiple, this EBITDA on the bottom is going to have 100% of the subsidiary. And I just realized this thing's in the way. Sorry about that, guys. So 100% of the subsidiary is in the EBITDA, whereas only 75% of the subsidiary is in enterprise value if we don't add this. Why is that? Well, the shareholders over here, they only care about the part of the subsidiary you actually own. They don't care about the part you don't own. So they're only going to value your company as if you own 75% of the sub. But we want to make it so that we own 100%. Why? Because the numerator has to be consistent with the denominator, what we call quote unquote apples to apples. You can't divide a different unit with a different unit. So that's why we're going to add back this minority interest. And this minority interest is basically the 25% of the subsidiary we don't own. It's often just a number in the balance sheet that you can find. You can pluck it and you can just throw it in. So that's why we get enterprise. That's why we add back minority interest. So, and you'll see that these multiples are very important. Okay, so we kind of went over enterprise value. What are some challenging questions, enterprise value? Common one is like capital leases. Would a capital lease increase or decrease your EV over EBITDA multiple? Well, a capital lease is like borrowing something, like owning something, sorry. It's like if you borrowed a car for 15 years, you basically own the car. The thing's beat by the end of it. So we call it a capital lease because you basically own it. Your payments represent interest and principal, which are below EBITDA. So relative to an operating lease, you're going to have a higher EBITDA and a lower EBITDA multiple. Operating lease is just like paying rent. It's an expense. So you kind of get the opposite here. So long story short, you want to find the impact on EBITDA, and capital lease is below EBITDA. So that's why we have this. Okay, let's jump into multiples. First of all, I mean, we all have heard the term multiple, but like, why do we care so much about multiples? Why is this like the primary way that people value companies? And when I say that, you're probably thinking, well, don't people use DCF? Yeah, but this is easier. People use this a lot more in investment banking too. So let's take a look at this. We're basically saying what we're paying, and the bottom is like what we're getting. So it's like, think about it as real estate. It's like dollars per square foot. You're going to pay a certain amount of money to get a certain return on an asset or a certain something, right? So that's what that is. Same here. Now, why they're enterprise value versus equity value? This one you've probably seen before, price over earnings. Very commonly used because it's very easy to calculate. However, it only reflects the equity holders. Enterprise value over EBITDA reflects both the debt and the equity. We're going to see that EBITDA is a really nice number. Why is that? Well, EBITDA is, you probably learned in class, it's basically like a proxy for operating cash flow, right? It's a really nice, clean number. And it's clean because it's before interest. So it's debt structure, capital structure neutral. It's before taxes, so it's tax jurisdiction neutral. It's before D&A, so it's depreciation amortization, so it's accounting policy neutral. It's neutral to all these things. So it's a really great way to kind of value the company and see like what you're paying versus what you're getting. We don't use price over earnings because earnings is an accounting number. It has interest, it's got tax in there, it's got D&A, it's got all kinds of garbage. We don't want that. So now it's easier to calculate, so that's why it's used. Now you would use P over E over EV over EBITDA in certain situations, which is for financial institutions. Banks, private equity firms, debt is the core part of their business, right? They borrow money at a cheap rate to either return on a higher rate, so we want the interest in there. So we actually want to look at price over earnings in that situation. Now multiples, they're two kinds, right? You can look at the future, so like enterprise over next year's EBITDA, or you can look at the past. The future is more useful when valuing a stock because a stock is the value of its future cash flows. So now that being said, in private equity, where many companies are private, you're going to use last 12 months because you might not have those forecasts available. All right. Now, there are a lot of industry specific multiples. I won't get into those, but you can take a look. Like the long story short is resources, EV over production is a big deal. So I don't know if you're applying for a resources interview. So yeah, if you're a specific group interview, you should definitely take a look at those. Okay, so I've covered a bunch of concepts. I want to take a step back. What does this mean? Like, what would this look like? Like if I was trying to do comps of like, this is a made up company, Alabama Farms, not a real company, and I found a bunch of similar companies and I filtered them and I decided like, these are the ones that are the most similar because of size, because, the multiples, and more importantly, what they actually do as a business, right? So you build up these comps. Basically what you're trying to get to is like a median. You're trying to find a median EV over EBITDA. And you can basically just take that median, whatever that is, in this case 9, and you can see that the median is higher than Alabama Farms, right? So if I take this 10, apply it to the EBITDA, bam, I pump out a 10 billion enterprise value. So that's one way to do it, right? That's one way to value a company. So one interesting question, and I'm realizing I probably am going to touch very briefly on the more advanced topics just because of time. I realize I'm kind of going this a little slower than I could be, but anyways, price over EBITDA. Sorry, this is not a valid multiple. Why is that? You're taking an equity value, comparing it to a enterprise value. That's pretty straightforward. This is an interesting one. How does debt affect price over earnings? Price over earnings usually goes down. Why is that? Well, more debt means more risk to equity investors. And it's actually a mathematical thing. If you want to understand it mathematically, specifically, it's this. By increasing equity, you're increasing your levered beta, which increases your cost of equity, which decreases your stock price because your cost of equity is like your discount rate. But if you want to just keep it simple, it's because of increased risk. Okay, sometimes it can go up though. And why would it go up? Well, that could be a positive signal. So like if this company needs that cash to survive, okay, investors are going to be like, that's a good thing. Or maybe they're going to like use that debt to buy another company or, do something interesting with it. Okay, so that's why. All right, so I think that's good for